Muy buenas tardes. En esta ocasión ya voy a hacer la entrega de la semana 12. Para este contexto voy a inclinarme por la opción 2, la lectura en inglés y dar pues como mi resumen en el tiempo correspondiente. Entonces, para esta ocasión estoy manejando Research International Business and Finance, a full ledger article. Impact of interest rates of the life insurance market devel- development gross country evidence. Astra. Studies have found that interest rates create incentives for insurance firms to focus on financial markets through investments. Using a cross-country context, we conjecture that interest rates affect the life insurance market development. Using an initial sample comparison the time series of interest rates and insurance market measured from 34,000 countries across 1998 and 2018. We found that the destiny and penetration of the life insurance market is low in the country with high interest rates. Using another sample of 6.451 observation from insurance firms operating in the same three four countries, we verified that the financial and operation incomes are quality significant in predicting the net income for life insurance companies that operate in countries with high interest rates. Our study contributed to observations that the lack of government control over public expenses impacts interest rates and thirdly, the opportunities for insurance. 1. Introduction. The global development of the insurance market impacts economic growth and progress in the financial market. Insurance plays an essential role in the capital systems, covering operation risks and allowing firms to redirect financial investments to the other industries. However, the insurance industry is heterogeneous, comprising two main subjects: non-life insurance and life insurance. Non-life insurance generally is short-term contracts, while life insurance has a long-term contracts. Segregating life and the non-life insurance is fundamental within the insurance industry, as the insurance company must manage a pool of risks where the similar exposures from insurers are aggregated to handle loss. Companies must allow the compliance from clients of a robust portfolio of investments. Thus, the guarantee asset to face loss in long-life insurance many focus on short-term yield, while factors related to life insurance may focus on long-term investments. Thus, economic policies can impact the insurance market, especially when considering the investments available to compose the guarantee asset portfolio. Monetary and fiscal policy, for example, affect the interest rate, which are used as an index of public bonds. According to Fisher, interest rates are determined by the opportunity to save money, which is investment in the financial. Countries exhibiting fiscal indiscipline tend to foster research from market players, consequently increasing the interest rates. Considering that insurance companies are surplus players, They are likely to focus more on obtaining gains in the financial market of countries with high interest rates than from operation activities. Thus, this study presents question is the following: Who do the who does the level of interest rates affect the life insurance market development in cross-country contexts? We also unable to how the net income can be predictive and financial operational result be comparing countries with historical higher and lower interest rates. Our main argument is that in jurisdictions with historically high interest rates, insurance firms act the quasi-battling institution focus of financial markets, especially on interest revenues, than of the premium revenues and therefore they lack an insurance market development. Furthermore, this economic behavior impacts the life insurance more than non-life insurance because of the long-term nature of the former warranty assets. For our investigation, we apologize to all statistical approach first. First, we perform country-level tests using panel and time series data. We consider measures from the World Bank regarding the development of the insurance market, penetration and density, and historical interest rate for 34 countries across 1985 and 2016. The main results indicated that interest rates are negative relative to penetration for the insurance market, and these relationships intense impact life insurance activity. For robustness test, for no risk test, development time series analysis stroke vector autoregression, and greater causality was results compared that countries with higher interest rates both love the development of insured market with higher impacts to life activity. After this country level assent, we performed with firm level tests using panel data model to verify the relevance of the financial and operational results on the insured. Net income, considering the interest rate, the compound for cluster. This assessment was based on the sample conspiring film observation from the 24 countries. Our many results to film 11 tests demonstrate that equal countries with high interest rates. Financial count operation results are required relevant to forecast the net income by 1 year, indicating the prominence of the financial results. Further, we evaluate the same relation for non-life insured companies issued non-life as variable for robustness check, considering that non-life insured does not suffer the same long-term interest impact as life insured. This example present significant cross-country heterogeneity in terms of economic environment, enabling the interest rate impact of the development of life insurance market to be evaluated. Interest rate and the financial market are two crucial factors for country economic growth. This study contributed to the literature be showing the negative association between high interest rates and market development and formats a further category these effect into life and non-life activities. We argue, we argue that this relationship stems from undisciplined fiscal police, which are chart certainly be inflation and growing trade deficit. Financial market reacts to fiscal policy. Revenue-based adjustment lower the spread more than spending-based adjustment that the tere for fiscal policy present higher rate of interest. These effects of undisciplined fiscal police, then to creating investment bias in financial and insured market, especially for life insured that future long-term contracts. This feeding she lack of the links between monetary policy and this insured market development, indicating that in countries with poor fiscal policy, insurers are more focused on interest earning than operational operational earnings. Beyond bank specific variable condition in the which banks face uncertainty in the macroeconomic anymore environment which with undisciplined fiscal policy increase interest spread. The reaction of monetary policy to the stock market is inverse generally. There is a negative relationship between two. This study result may be of significance to market regulators in suggesting that undisciplined fiscal policy, which induce a monetary policy to establish higher interest rates, created by insured activities. These bias produce quiz banking, business, monetary policy. No, sorry. Um, the SBI's okay. The SBI's produced quasi banking business operation in ensures and weaken the industry benefits to country economy. A possible cause for this call in a possible cause for this account the bad operators invest a considerable part of their premium in government bonds to assure their continued. Thus, insured operation is countries with high interest rates gain more profit through their returns from public bonds than from their operation activities. The remainder of this paper is organized as follows. Section 2 reviews relevant literature and rationales or hypotheses. Section 3 explain or the data collection and statistic produces. Section 4 contains the empirical result and test. And section 5 concludes the paper. 2. Theoretical background and hypo, hypothesis development. Financial development has been studied by several authors, and this study often evaluates the link between this financial and insured development. More recent approaches have focused on the integration of financial development, insured development, and economic growth, showing that development of life insurance positively affects economic growth per capita. However, the insurance industry has idiosyncratic features that are not clearly explored. Our study contribute to understanding the extent to which the insurance market could impact and be impacted the financial and economical conditions. This word does not I not explain the relationship between supply and the demand for insurance, although several authors highlight that the microeconomic, demographic, social, and industrial aspect can influence consumers' behavior and also firms' willingness to operate in certain segments. The insurance industry diversity might be defined by the segregation between life and the non-life insured. Dixon explained that life insurance is the contract between a client and an insured, in which the insured plays a beneficial open there that in the charge for the premium. In non-life insurance, this activity contains the insurance of an insurance policy to cover property risks. Insurance operational dynamics vary between life and the non-life or related activities. According to Dixon, life insurance can be understood as a long-term investment that requiring periodic payments concerning non-life policies. For Watson and Hyde, this policy of the coverage of property for a short term, generally 1 year, and broadly speaking, they offer protection against loss and damage. Therefore, because of the distinction, life and the non-life insured have a different satisfaction, producers relied on the composition of the technical liabilities, reserves, and guaranteed assets. Specifically, guarantee assets are the assets being required to face the loss insured by the policyholders in on period. For life insured, these assets are locked-in oriented within the non-life insured. They comprise a mix of short and medium-term investments. Several authors, several authors have studied the allocation strategy of the guarantee asset and their impact on the rain probability of insurance companies. However, this use has gained traction after the solvency to a grant which created new recurring and forced insurers to restructure their investment portfolios. Solvency II is a harmonized prudential framework for issued in 2009 and endorsed in 2016 and regulated life, non-life, and insured operation. The Solvency II established prudential requirements tailored to the specific risks that each insured bears. Following this study focused on the major five. Risk-based capital requirement. These standards ensures that insurers firms hold capital regarding their risk profiles to guarantee that there is insufficient financial resource to withstand financial loss. B. Governance and risk management requirements. Solvency II requires insurers to implement adequate and transparent governance mechanisms and conduct risk and solvency assessment. And G. Supervisory reporting and public disclosure. Solvency II allows supervisors to evaluate the prudential equity to ensure the consolidation. The solving requirements The solving requirements are a reflection of the requirement that insurance operation must be secured with financial resources to cover the insurance policy shoulder, loss and damage. Furthermore, a majority of the portfolio must comprise public bonds because of the robustness and low-risk nature of these investments. Therefore, life insurance managers seek investment that might be used in covering benefits. Generally, local government bonds are preferred for this purpose. However, for non-life insured is a short-term public bonds, such as treasury bonds. Government bonds are issued to finance public spends and investments in sovereign field. Thus, a sovereign government needs more funding. There is incremental interest rates to attract debt investors. According to Fisher, the interest rates gradually move market investments because of the possibility of maximum returns. Fisher also suggests that interest rates are composed of real interest on inflation, which can be increasing according to the country fiscal and monetary condition and be considered a being government debt. Barr and Campbell note, that interest in yields might be from an increase in expected inflation. Similarly, Spiro Higley that there is a satisfactory relationship between government debts and interest rates. Thus, it is possibly than in countries with higher interest rates. Insured firms and the more motivated to gain profit through financial application than operational activities. Okay. As governments must increase the return from bonds. As Maverick mentioned, drops in interest rates can decrease an insurance company liability by decreasing these future obligation of policyholders. However, Marevic also highlighted that lower interest rates can affect insurance firms' profitability as they often the returns of finance investments. Regarding life insurance, Berendt mentioned that life insurers are exposed to the interest rate setting because they sell long-term products whose present value depends on the interest rate. The authors also argue that life insurers are exposed to the interest rates through the behavior of policyholders, which can change with the level of interest rates. Mollman states that holding illiquid and long-term assets to maturity can save insured portfolio adjustment costs until level then they earn an illiquidity premium. However, a prolonged low interest rate AO format could lead to raisement. Uh, in summary, considering that insurance companies must, as government bonds, as government assets, and the bonds the index using the public interest rates, the income is expected to have great relevance to the bottom line of insurers located in the countries with high interest rates. Furthermore, it is expected that this effect is more prevalent to life insurance as their products are long-term contracts. Based on the argument, we propose the following. Hypothesis 1. There is a negative relationship between interest rates and the life insurance market, destiny and penetration in the long term. Hypothesis 2. The financial income of life insurance located in the countries with high interest rate is more relevant to predict the net income 1 year have than income insured in countries with equal interest rates. Both hypotheses have been directed at life insurance because of the operation feature subject in the literature. However, non-life operations were also evaluated from Ron's desk main assessment. 3. Bethune 3.1 data. To investigate our hypothesis, we employed a dual satisfaction approach for hypothesis. One, we conducted a country-level analysis of interest rate and insured market development, proximity and penetration. We used macro data of 34 countries from 1988 to 2016. Collect from the World Bank Open Data, which has the complete observation for the variable from the minimum of the 5 years during this period. It must be highlighted that the information before the 1985 was inconsistent with only a small number of observation and no information was available after 2016 during the data collection. To verify hypothesis 2, we performed fine life tests evaluating the relationship between the financial and operation results on the net income and the relation 1 year had, which are controlled by interest rates clusters. The firm observation used to cover the period from 1999 to 2017 and were collected from Thomson Recruit Eaton. This period was considered because in the contains the available information for our sample. 3.1.1 Country level data, variables, and models. The variables related to the insured market development destiny D and penetration P were collection from the World Bank data. Destiny in calculating using the direct gross premium dividend by population size, whereas penetration is the direct premiums, direct big gross products for more that segregates this indication by life insurance, GDP, and interest rates. Table 1 presents the variables. To analyze policy 1 between LD, and LP, we use okay this form, this continue, and where I equal 1.2.3 for 334 represent each country in the panel at Tn is in time. The natural logarithm time, the GDP, control the economy effects. Strategy control variables, D and P are converting into natural logarithm variables. Okay, these other variable, mm, definition, the table, the for 11 variables. Pum, pum, pum. No, no, no. Okay, for 11 data and models. This is following model using the hypothesis 2, sorry, por in the final period of data. Okay, findings. This section presents the univariate and multivariate result of time Two very big hypotheses, one and two. Univariate analysis. Double three. Reported fear observant bees insured subjects and countries in panel A, the United States, in the most represent and therefore is separate from the other countries to mitigate potential bias from in the average of the total sample panel B show. Life no life, Australia health number one, life 18, Austria nothing, Belgium nothing, Bolivia life and heart 339, Brazil 14, and automobile 21, and Brooks. Oh, sorry. Okay. Property Australia. Okay, this is focus the two different observers. Okay, this life, this no life. This Colombia life 19. No, okay. The school satisfaction for the observation. Dun, dun. Multivariate analysis. Country level results show the feeling under the evaluated hypothesis down the regress on the panel according to the result obtained in panel A. ER negative of after, a down with an unsatisfactory significator. Now, regression among sure the problem works to be decisive on penetration. Continue these firm 11 results. Okay. Table 7 present the result from a Q3 where panel A showed the printing the life of the normal insured cement in plan B. Panel B present the result from the insured observed the panel. Okay, the total event, doubling the net income, the churns, breaks of the operation income, the per church, and interest income per church ledgered in the fiscal year controlation. Controlation variables one ONES, ONES J2, panel C fitting the in NES in non-live subjects. Why? Conclusion. Yes, conclusion. It started be corroborated through the time series analysis. We believe that high interest rates negatively affect the life in the short market. The development down the non-life insured segment is unaffected. Moreover, in countries with high interest rates, that the financial income is equally significant to operation income in predicting the net income 1 year ahead. The result corroborates that life insurance firms act as quasi-banking institutions where interest rates are high. This variable is potentially motivated by the insurance products tra- characteristics like pension, work life insurance, universal life, etc. that require expiring periods to become financial advisement further. Further, companies are legally required to allocate new investment in government bonds as guarantee assent, creating a per- pervasive effect to the life insurance market. Development, whereas the non-life insured are the required to keep their reserve available for negation, not taking advantage for compound interest to pay short-term claims. The countries with the lowest insured market density and penetration are those with high interest rates. Additionally, in an inversely and competitive market like the USA, financial income is more relevant to net income than the operational earnings. This finding presents to an opportunity for future students aiming to evaluate how interest rates affect development in short markets and whether there is a edge in the impact of the interest rates of the life insurance market owing to market competitiveness. Further studies can investigate how an increase in the interest rates can negatively affect the life insurance market considered is a long-term orientation. Moreover, the result main interest market regulator is demonstrating how regulation by government authorities can impact the insurance market approach. Author Sandman, the author related the paper impacting for the development of life insurance market across country. Evidence tends testing that over together prepared this inclusion. Okay, eso fue como todo lo que es el artículo. Bueno, realmente se me creo que fueron casi menos de 20 minutos, pero no sabía cómo poderte expresar el tema de las variables que se manejaron para lo que fue como todo el enfoque y pues como todos los marcos macroeconómicos. En sí lo que se está manejando ese tipo de análisis o este estudio es poder confirmar según cuál es el impacto que maneja la tasa de intereses para el tema de las pólizas para las pólizas de seguros. Aquí se están manejando dos tipos de focos, tanto la póliza de seguro de vida como la de no vida. En vida va muy enfocado efectivamente en vida, pero también va asociado en el tema de pólizas de salud, eh, pólizas de responsabilidad odontológica y las no vidas son más que todo tipo empresariales, que va también muy asociado a pólizas de hogar, perdón, pólizas de hogar sería como asociado para el tema personas. Bueno, va asociado como en los dos campos, tanto personas como empresas, en el campo de vida y no vida. Según lo que dice el análisis es que según lo que sea, cuál sea la irregularidad que se pueda manejar dentro de cada una de las compañías de cada uno país, según una muestra de los 34 que se evaluaron, se puede manejar el cuál va a ser el interés que se plantearía en el tema de los seguros, ya que el seguro, aparte de tener un respaldo al caso de los desastres que se puedan como cubrir de se me fue la palabra. Bueno, los seguros lo que harían, bueno, después, atrás de, no solamente para proteger y tener como el dinero para poder llevar como ese tipo de, sobre el costo que va a llevar, pues como poder mitigar esos daños causados por bienes o las personas aseguradas, también lo que efectúa la compañía de seguros es poder invertir ese tipo de capital por medio de los intereses. Entonces, según cuál sea el proceso de la irregularidad fiscal que pueda tener cada país, las aseguradoras van a manejar lo que es un mayor incremento en el capital a largo plazo que a corto plazo. En corto plazo va a manejar más que todo lo que es el interés de las no vidas. En largo plazo se enfocan más en lo que corresponde a vidas. Entonces, según el análisis de los diferentes países, lo que ellos hacen es como poder confirmar cuáles serían las mejores estrategias para poder determinar en los países, digamos así, con desarrollo económico, las estrategias donde se enfocarían mucho más el tema de intereses financieros para el proceso final de lo que es la inversión de los seguros de vida y de los seguros de no vida. Agradezco mucho la atención. Bueno, feliz tarde.